Hi everyone. Third quarter had some ups and downs. Let's take a look backwards as well as what the economic data shows that may be in store for our portfolios going forward. Across the board during the third quarter, we saw negative returns across many asset classes. Now this is despite having one of the best returns coming into the third quarter. The pullback wasn't just isolated to the US. In fact, most countries around the world saw some negative returns during Q3. One area in particular that has been hit hard has been with real estate. We see some negative returns on real estate. One could assume that part of this is due to the rising interest rates that we've seen in the mortgage and lending world. We still have an inverted yield curve, meaning that short-term interest rates are higher than longer-term interest rates. However, that yield curve has flattened out. As you see, the dark gray line there has come up from where it was in June of this year, as well as 1 year ago in 2022, where those longer-term interest rates have come up and are closer to those short-term rates. Now, how does this apply to our portfolios? Well, if we look on the left side of the screen, the red line chart, the 10-year Treasury yield is about 1.9% higher than inflation. And when it gets into these higher territories, that could be good news for bonds, but it may mean that stocks are going to have a little bit lower returns moving forward. Now, although the Fed has been raising interest rates to combat inflation, we do expect that that's coming to an end. The Fed has left the door open for perhaps one more interest rate increase, but most people are thinking that in 2024 we'll start to see some interest rate decreases. What does that mean for our portfolios? On the right side, you see the bar charts. During a rising, a pause, and a cutting interest rate environment can have various impacts to both stocks and bonds. Now we are seeing some opportunities for buying into various asset classes. So in this chart, the dark bluish green spot, anytime that is under the zero line, that indicates that that asset class is trading at a historically cheap compared to its average. Anytime it's above that zero line, it's trading at a point where it's relatively expensive compared to the average. So there's a few asset classes that do have some more upside potential perhaps than others. And we are seeing some perhaps overbought or at least higher prices on the US growth and large cap and high yield. Now with the Fed raising interest rates to fight inflation, that can lead to an economic slowdown. What this chart shows are the various asset classes that can hypothetically perform better at various times during the economic cycle. Now, unfortunately, we do have war breaking out in Israel. If we look backwards at how war impacts markets, it's not necessarily bad news. And in fact, there are some cases where markets perform better during those war times. Here's one of the latest wars, Russia-Ukraine. You notice on February 24th, we see a big drop in the market where it actually opened lower than it closed the day before. However, the red line is the US stock market as measured by the S&P 500. The blue line is international developed markets. And you can see there is a rebound that occurred in the days and weeks after that initial drop when Russia invaded Ukraine. So thank you for taking a look back with me at Q3 and what we might be expecting going forward. If you do have any questions about your own portfolio, please feel free to reach out and look forward to talking with you. Take care. Bye-bye.